Yo, guys, what's going on? This is Blaze is Cyan. I know it's been a little bit since I posted my last video, been about a month. Don't worry, I've not been slacking. I've been learning more than ever, and I've been delving into some different areas recently, and the main thing that I've been studying recently is this hedge fund business, which at the moment seems to be a glitch in the system, right? Every once in a while there comes a business or, business model that exploits the system, finds loopholes in the system, ways to, get ahead that, eventually aren't going to be able to be exploited like the way they are being right now. And that's what I think this business is at the moment. And so I read this book about Jim Simons, the man who solved the market, how he launched the quant revolution. And it's a great book. And some of the results that Simons got with the fund were just absurd. I believe they've, in 2007, 2008, they were making over 100% returns. And so I just wanted to walk through this and kind of talk about some ideas I learned from the book. And, a lot of this is going to be about finance. I think moving forward, I'm going to be talking about finance quite a bit more. I'm reading another book right now about hedge funds. And so if you guys like the talk about finance, let me know. Something that I'm really delving into right now. And so, let's get right into it. So I'm going to start off at chapter 3 because chapter 1 and 2 is about Simon's early life. I can touch on that a little bit, right? He's actually from the city where I'm living, Boston. He, became a professor, mathematician, and that's what he was for a long time, right? His 20s, 30s, he was a professor, college professor. And then at 40 years old, he got into this business. So it's a very different, unconventional path. And I think that unconventional path is the way that all of these guys really get to the top, right? I think the guys that, study finance, then go on to Wall Street, they don't end up getting to the top, right? It's the guys that take a bit of an unconventional path. They don't climb the ladder, right? They're not caught up in conventional thought. So that was Simon's kind of early life, and now he's starting the firm at 40. And so let's get right into it. Simons thought that markets didn't always react in explainable or rational ways to news or other events. He thought that markets exist in various hidden states that can be identified with mathematical models. That's what Simon's firm, Renaissance Technology, is famous for, right? Using mathematical models to, make money on the market. He bought currencies if they moved a certain level below their recent trend line, and sold if they veered too far above it. Bought currencies if they moved a certain level below their recent trend line, and sold if they veered too far above it. Right? So in a way, Simons is being risk averse here, right? Investing is a game of psychology. It's knowing when to pull out, right? You can always, what I've learned reading all these guys, like you can always, look back and say, man, if I stayed in, then I would have made so much more money. But at the same time, you never know if you would have still pulled out at the right time, right? You have to be disciplined. That's what I learned. And it is an incredible business that requires you to have complete control up here. You cannot get emotional. The emotional bets that these guys make are really the ones that end up flopping, end up causing them to lose millions, billions of dollars. And so, yeah, they made bets on currencies. It reminded me of Soros with, breaking the Bank of England, currency speculation. They focused on various momentum strategies and potential correlations between commodities. And yeah, so let's go to chapter 4. They purchased historic commodity price data, right? This is all about data. Renaissance had so much data. And this was the most important piece of the puzzle. This is just how Citadel is also, one of the titans, the most profitable hedge funds. They programmed past price moves into their trading model, hoping to predict the future. A probability distribution could capture futures prices as well as other stochastic processes. They use stochastic differential equations for risk management and actions pricing. They created data by making educated guesses as to what was missing in the historical data. And then we get into Axcom, which was kind of like a split off of the firm. Axcom was in California. Jim stayed on the East Coast. There are two trading strategies. Axcom's two trading strategies: chasing prices and a reversion strategy. And then, they get into how Simons and his partners fighting and how it hurts the firm. And then, someone in the book who was important, his name is Berkelkamp. He advocated for shorter term trades. Thought that investment prices often fell before key economic reports came out and rose right after. Let the data point them to anomalies, signaling opportunity. They let the data point them to anomalies, signaling opportunity. I love this line. The why didn't matter. The trades just worked. They didn't care why the trades were working. They just worked, guys. Something's working. Don't get caught up in why, overthinking it. They cut the average holding time from 1.5 weeks to 1.5 days, right? So they became much shorter term traders. They made mostly short-term moves. Long-term trades represented 10% of activity. And then at this time, they were charging 5% fees on all assets under management, which is absurd. It's absurd. Most firms charge 2% on assets under management and then 20% on the profits. But they were charging 5% management fee. So just to hold money, right? Just for people to park their money at the firm, they're charging 5% of that money in fees a year. That's just, think about, if you're one of these titans, right? Top of the industry, you got 50 billion, 100 billion assets under management. 5% on that a year in fees. It's absurd. It is really absurd. Prices often move in long persisting trends. And then in the book, I've been watching and listening to stuff from Druckenmiller for a long time. And they mention in the book that Stanley Druckenmiller consults charts to confirm existing investments. I thought that was interesting just to throw in. And then they talked about what a stock warrant is. It gives the holder the ability to purchase shares at a certain price. And then let's get into here. They had a single trading model rather than various models for different investments in market conditions, right? So most of these firms had different models for different types of investments, different industries, different markets. But at Renaissance, they created a single model. And that was something that was super unique to them. No one else really had done that. They carved the day into 5-minute bars to track patterns. They directed trades to various futures exchanges to reduce the market impact of each trade. They reduced the impact on prices by focusing on the periods where there was the most volume. Chapter 9. The trading system had great ideas, but what went wrong when trying to implement trades. And this is why you can't just rely fully on the system. They learned that there was a certain amount of human intervention that was necessary. The inputs that they put in were the fund's trading costs, its various leverages, risk parameters, and assorted other limitations and requirements. The firm's core strategy was reversion to the mean predictive signals. And then here's a quote from the book: "We make money from the reactions people have to price moves." They mapped the 2-day trajectories of various investments. Again, thinking short-term trading. Patterns resulted from relationships between price, volume, and other markets. Let's see. Their data was based on historic behavior of investors and other factors. And then they talked about D.E. Shaw, obviously another big hedge fund, talking about how their fund was market neutral. They said never place too much trust in trading models, right? Again, talking about, the need for some human intervention. When market volatility surged, they automatically reduced positions and risk. The Medallion Fund, which was the main fund, it's still around today, of Renaissance Technology, performed better than Soros, Paul Tudor Jones, all the other best investors. This is the best performing hedge fund in history, Renaissance Technologies. And then, but of course that doesn't mean they didn't have their rough patches. They lost $300 million after the tech crash in 2000. And then they talk about the Sharpe ratio, which is returns in relation to volatility. They had a super high Sharpe ratio, which meant, that they were super safe to invest in, right? I think they got up to like a 7.5 Sharpe ratio at their peak, which is crazy. They generated enormous returns from a diversified portfolio, generating relatively little volatility and correlation to the overall market. Right? Like a lot of these hedge funds are correlated with the market, right? And you think to yourself, well, why wouldn't someone just want to invest, in an index fund, right? If your hedge fund is just directly correlated to the market. So that's why these differentiating factors are very important, right? Why would someone invest with you if you're not making substantially more in returns than the market is? They used more leverage to amplify their profits. Medallion had a $12.50 in financial instruments for every dollar of cash. And then basket options. I thought this was super, super interesting. Basket options were essentially a financial instrument where the bank, right? The bank will invest in a basket of stocks, right? Of securities. And I remember them mentioning in the book that Renaissance told the bank which ones to invest in, right? And technically it's the bank's investment, but for all intents and purposes, it is actually Renaissance's investment. And then essentially Renaissance had the option to, buy, it's essentially buying that basket of options from the bank. And so, the returns that they generated from doing that was insane. Chapter 13, Simons gets into a little battle with Izzy Englander, tells him to stop poaching his employees. And then they talk about in 2008, right? Investment psychology. This was a crazy, volatile period. And, Simons got scared in 2008. Started, pulling back on positions because his psychology got the better of him. If he hadn't done that, then they would have made a lot more money. But since, he was starting to see losses, he was like, look, I don't want this to be devastating, so let's play this safe. And he didn't trust in, the algorithms, the processes they had in place to weather the storm. So he ended up making a lot less money than he could have, even though their funds soared an incredible amount in 2008. I have here it soared 82% in 2008. And yeah, then it gets into Bob Mercer and Donald Trump, all that controversy. But yeah, I thought that portion of the book was the most important. And I really think that Jim Simons really just created a behemoth here. And I have a hard time, picturing how they're able to do this consistently year after year, generate such high returns. But I'm getting a better idea of it the more I learn. Reading books. I have a book right here, sitting here, Hedge Fund Market Wizards. Got another one, More Money Than God. I'll make some episodes on those. But yeah, guys, this business is wild. People are making unbelievable amounts of money. I don't know how long it's going to last. Ken Griffin, for example, he made $4 billion last year. $4 billion. I mean, it's just absurd, and I think that's why everyone's jumping into this space. They were like, well, I want to start a hedge fund. The reality is those guys got in early, right? It was a lot of timing, right? They got in early. Back in the 80s, 70s, and the 80s, there wasn't, a ton of hedge funds. Now there's thousands of hedge funds. Everyone wants to start a hedge fund. And, it's just not a good idea to jump into a space that is already saturated, right? And just become another commodity. You have nothing differentiating you. You're just following this wave because you see all these people making money. But what I'm thinking about is, okay, what is going to be a future investment vehicle type of firm that doesn't exist today, right? And starting to think about that, thinking outside the box. How can you innovate, right? Not just within the business, the same business, starting another hedge fund that's different, but starting a new type of investment vehicle altogether. That's thinking outside the box, right? People are focused, stuck in conventional thinking. We have to think outside the box, guys. And so I hope you enjoyed this episode. Guys, stay focused, right? Stay focused on your mission. Try to avoid making big mistakes. I know where I'm going to be in the future, and you'll get frustrated along the way because no one will understand you. All right, you won't feel like people will get it, and you'll see all these people stuck. But just know that you're well on your way. You're watching this, you're studying, you're learning. You'll get there. I hope you enjoyed this video, guys. I will talk to you soon. Blaze the Cyan, signing off. Peace.